Hey, good evening, everyone. Good evening.
Hello.
Hi. I'm glad that you guys.
Good evening.
Good evening. I'm glad you guys are here because
That's right.
even I I don't know if you've been if you had no problem connecting to Blackboard, but for the last like 30 minutes, I've had I don't know the probably a BMCC server could have been down, but I've tried so many times, but to no avail. There was no connection whatsoever. And then finally, uh,
Yeah, we had issues also.
you did too. So when,
Yeah,
okay,
me as well.
okay, so it wasn't only me. I mean, it was obviously it wasn't obviously it was the server issue, I guess. It wasn't just an individual issue. Okay, all righty. Great. So let me quickly check. Okay, let's do this. All right. So I see like 20 to 21 people. Uh, Looks like the connection was back uh, from 6:03. Okay, and then I see 20 people, 18 people. Why 18? Um, 20 people here. Why is it saying 18? Oh, okay, including one currently joining. Um, all right. So we were talking about um, the cash flow analysis last time, right? Let me just quickly check where we were on last Wednesday. Okay, I need a lozenge for my throat. All right. Hey, good evening, everyone. That was from good evening. Non-operating cash requirements. With the lower production capacity, your output will be lower, right? Right. Um, a company that doesn't have positive free cash flow is a company doomed. Okay, so that was I guess the last thing we talked about. Free cash flow, right? And free cash flow is quite the concept of free cash flow is quite important, especially when it comes to stock valuation. And in Finance 100, this was discussed, but also in Finance 300, free cash flow model. In Finance 100, I could only introduce a very easy model, easy example, very simple example. But in 300, there can be there's a more complicated uh, example in 300 free cash flow model example. Uh, so let me open that. I think it is already open. I opened it already. Uh, um, so the bottom line, um, the ultimate result conclusion of uh, the the balance sheet and income statement analysis is free cash flow, right? Uh, but more than the fundamental analysis is more than just the it's more than just, balance sheet. What's going on? It's giving me a hard time. What is this? What happened to the one that I used last time? Oh. What happened to the one I used last time? So I'll have to open a new one then. Oh, yeah. Okay. Oh, it looks like it's updated. Okay. So here, okay, I think this is good. So fundamental analysis. My handwriting is analysis. Okay, that's terrible. So basically, from eventually we'll need to arrive at, from fundamental analysis we'll have to arrive at ratio analysis. Ratio. Yeah. How do I? This is giving me a headache. Oh, exit ink mode. I see. Basically, ratio analysis is fundamental analysis, but you can say the final result or the pinnacle of the fundamental analysis is the ratio analysis. So it's literally ratios. It's about ratios, right? Ratio variables. And in ratios, oh, that's with the arrow. There are 5 categories in ratios, right? The first is, can I change the color? First category is profitability ratios, profitability category. Second category is liquidity. Now, liquidity is actually, a short-term phenomenon. Liquidity category ratios are mainly short-term liquidity. It's about short-term liquidity. And the third category is asset management. And the fourth category, okay, out. Debt management. And the fifth category is stock valuation. They just call it valuation. Valuation ratios, valuation category. So largely 5 categories in ratio variables, and these are, crucial indicators of how the business is doing. Crucial indicator. I mean, by looking at these ratios, you can easily tell how the business is doing. So it's a very solid. I mean, a solid indicator, right? First, there are in each category there are at least there are at least like three to four, especially in profitability. There are like at least 4 or 5 variables, ratios in this category. But in each category, I'm gonna look into only the major 2. In profitability category, maybe I will look into at least something like 3. But first, this is something we already know: return on assets and return on equity. Okay, and then in liquidity category, we're gonna look into current ratios, and quick ratios. And we can look into, the third one will be, we're going to also look into the third one, which will be the average collection period or so. And asset management. In asset management category, we're going to look into first, inventory turnover ratio. Inventory turnover. Oh, to write turnover, I'm going to have to. Inventory turnover. And then, so that's 1. 2, fixed assets turnover ratio. Fixed assets turnover ratio. And in the debt management, there will be, in the debt management, there will be times interest earned. You might think, what is can I add more color here? Okay. Is times. Okay, that gives me an arrow. I better not do that. Right. Okay, that's times, right? It's not x. It's multiplication, right? Times interest earned, and then the second one is total debt to. So in other words, it's going to be debt to total assets ratio, right? Debt to total assets ratio. So it's basically debt ratio. They call it debt ratio, right? And then alternatively, we can think about debt to equity ratio, right? Now, in the last category, which is stock valuation ratios, right? There are several, but we will look mainly in. I look at price earnings ratio and market price to book value ratio, right? Market price to book value ratio. So let's think about it. It's not a big. Okay. So so let's take a look. I have only that. Oh, no. What am I doing? What am I doing? Okay. The first thing is return on assets and return on equity and return on capital. Another return on capital, right? So as a third ratio, right? We're going to look at return on capital. I would ROC is looks like Russian Olympic Committee. So actually, I don't. I prefer ROK. Okay, ROK, which is as a third. Okay, let me add. ROK, return on capital. That's also like a Republic of Korea, South Korea. ROK, right? Now, return on assets and return on equity are quite well known. I mean, even from Finance 100, you learned this. And it's not difficult. I mean, where did I? Why is it? return on assets is basically EBIT by divided by total assets. It's a ratio, so EBIT over total assets. Return on equity is net profit, or EAT, over equity. I mean, they are basically the like they are input-output ratios. I mean, output to input ratio. Everyone understands what output to input ratio is, don't you? Right? You understand what output to input ratio is? Oh, come on. How do you measure productivity or efficiency? Everyone understands, what fuel efficiency is, right? Or fuel economy. What's a fuel economy? Fuel economy is exactly output to input ratio, isn't it right? Because fuel economy is basically miles, how many miles run over number of gallons, right? How many gallons, right? So the gallons, the amount of gasoline is the input, and the miles run is the output. And that's, there's no better way of measuring the efficiency, right? Basically, this measures the productivity, but efficiency and productivity are closely related, because the higher the productivity, the more efficient it is. And nobody says, nobody considers low productivity as efficient, right? Makes sense. Nobody says, nobody calls low productivity efficient. High productivity is considered efficient, but low productivity is inefficient, right? So it's like this, mileage, the gas mileage or the fuel economy of a truck like Ford Expedition, or SUV like, Ford Expedition, or Cadillac Escalade, right? We all know they are gas guzzlers, and they are gas guzzlers because they run only like 5 miles per gallon, right? They get 5 miles per gallon, and so that's quite inefficient, right? Compared to maybe even a tank would get 5 miles per gallon, right? Abrams tank, or it's like 60-ton tank will get, I don't know, maybe 2 miles per gallon, maybe. Compared to that, what would be the gas mileage on a hybrid car? A hybrid car would get at least 50 miles per gallon. It doesn't have to be, I mean, it goes without saying, maybe 60 miles per gallon. I have a small car, a Kia Forte, and it's a small car, relatively small, but, bigger than Prius, of course. And it gets like, if I drive on the highway only, I can get even like 40, sometimes 46 miles per gallon, 47 miles per gallon, right? Of course, driving in the city, it goes down to like 30 miles per gallon, but still 30 miles per gallon in the city. You're kidding. I used to have a big 8-cylinder 4-liter 8-cylinder, you know, a 5-liter 8-cylinder, you know, big car. And, you know, I could get only about 20 miles per gallon on the highway. In the city, 12 miles per gallon. If I get, you know, 30 miles per gallon, you know, it's in the city, it's great. It's wonderful. That's efficiency, right? And of course, fuel economy is something you would, that would be the first thing, the priority you would consider in buying a car. But, you know, think about it. All of these ratios are basically, all of these ratios are like output to input ratio. Okay. Probably except liquidity category, right? Except the liquidity category. Liquidity, it's also largely, you know, this concept, output to input. It's, you know, the higher this result, right? That's more efficient, right? It's getting more efficient. And so if you think about it, one thing, here's something you would find different from what you learned in Finance 100, because in Finance 100, so ROA, you may remember both ROA or both ROA and ROE, the formula was net profit over total assets. Of course, net profit is EAT, earnings after taxes, right? Divided by total assets. Also for RO, what do I do? Oh. Also for ROE is the same thing. Net profit over equity, right? But net profit is, you know, EAT over equity. But what was the formula here in the slide? You see, EBIT, right? Why EBIT over total assets, right? Return on assets is EBIT over total assets. Why? Well, think about it. We know total assets consist of what? Equity and yeah. This is what's going on here. Total assets consist of, you know, equity and debt, right? And then think about it. Profit is the result. Profit is the end result, final result. Profit is the result of, maybe I should use, profit is the result of both equity and debt, right? Profit is the result of both equity and debt, total assets. But then it belongs, profit, but eventually belongs to only to the equity holders, right? Profit belongs to only equity holders. That's the, in other words, debt holders to equity holders. It's hard to write here, right? In other words, stockholders, right? None of it belongs to the, none of it goes to the, not, none of it. None of it belongs to the debt holders. In other words, bond holders or creditors. Bond holders. Right, called creditors or lenders. Okay, so come on. So then how relevant, so think about it, from the debt holder's perspective, right? From the debt holder's perspective or creditor's perspective, this ROA formula is irrelevant because, I mean, it's not completely irrelevant. Obviously, the company that has higher ROA, right? Company with higher return on assets, higher ROA is definitely worth investing. I mean, lending money to, or buying bonds from, right? It's not completely irrelevant, but it's not directly relevant to them because debt holders only get their interest payment, right? They get their interest payment and principal, and none of that is before, right? All of those things are before profit. None of the profit goes to the debt holders, right? So for them, what is more relevant is for the therefore EBIT, not EAT, is EBIT is more relevant to the debt holders, right? So for debt holders, to the debt holders, okay, EBIT, not EAT, is more relevant to the debt holders. And then obviously then the formula would, it would be more meaningful for the debt holders to have EBIT, right, on top, right? And hence, right, therefore, okay, So now if we rewrite, so let's see, if we rewrite, I mean, and what, so now, return on assets, this one is for the debt holders, right? But if we have net profit in the numerator on top, that would be that is from the equity holders perspective. From equity holders perspective, that is more relevant. Now we understand return on equity, so I'm not going to go over that again. Return on capital, and capital means long-term capital, right? When we say capital, and I made this clear before, there's a difference between see, capital comes from when we say capital structure, right? When we say capital structure, yeah. When we say capital structure, it's basically, how much, it's basically debt versus equity, right? In other words, how much of the total assets comes from debt and how much of it comes from equity. So let's say the capital structure is 60% equity, 40% debt. But then in the debt, right, we all know there is, current liabilities over short-term debt. I don't like the short-term debt and long-term debt, right? What if this 40% breaks into 30% long-term debt and 10% short-term debt? Of course, if it breaks up like this, then 30% long-term debt, that's capital, right? This is called capital. And equity and long-term debt are called capital. Okay? Equity and long-term debt are capital. Right? Maybe this is where it comes. Equity and long-term debt are capital. So when we do debt to equity ratio, right, which will come later, right, when we, remember here, debt management ratios, there's debt to total assets ratio. In debt to total assets ratio in that example will be 40%, right? Because in that example, right, it's out of total assets, right? So it's like, 0.4 out of 1, right? So 40%, right? But if it is, a debt to equity ratio, then it's 3/6 because you're doing only, capital, right? You have to use only capital for that, right? And that's that debt to equity ratio, right? 3/6, then that is, 50%, half, right? 3/6. 0.4. Okay. So basically, profitability ratios all measure the productivity or the efficiency of the uh, of your capital, right? And then this thing doesn't belong here, financial leverage and ROE. Okay. So, but this doesn't belong here. I believe I just put it there because there was just so much, blank space, right? But I'm gonna get to this. A return on equity can be, the reason I put it here is the return on equity can be broken down further this way. 1 minus tax rate times ROA plus ROA minus, it's actually not R, but INT. I mean, so this is, you cannot, oh yeah, ROA, that's fine. ROA minus interest rate, right? Return on assets minus interest. So if you subtract interest rate, that's basically, taking away the effect of the cost of debt capital from the total return on assets, right? Times debt to equity ratio, right? So I'm going to come back to this because this is actually, something to be discussed later. And this is to show that as the leverage goes up, ROE will go up, ROE, right? So you might wonder, some people may think that the taking on more debt would lower the return on equity. No, actually taking on more debt will raise the return on equity. So I'm going to talk about that. Also, one more. So there was one thing I also left out. The fourth one is return on sale. Okay, return on sale. That's also profitability ratio. It's a kind of profitability ratio. Return on sale. Of course, return on sale it's obvious. When we say return, basically we use, profit. Profit over sales revenue. It gives you roughly the a rough measure of profit margin. So remove this a little. Move this to the side. It's profit over sales revenue. Okay. Now all of these, and when you have all of these ratios, right? How do you know if it's good or bad? Well, there is no way you can. Obviously, it should be positive number. All of these must be positive numbers, right? I mean, the ratios must be greater than 1, at least, not greater than 1, but, like greater than 0. All must be positive. I mean, nothing can be negative. I mean, if there's any negative ratio, that something's clearly wrong, because if your profit is negative, right, the only way the ratio can come out as negative is because your profit is negative. But then if your profit is negative, there is no such thing. It's loss. And then the ratio can come negative, come out as negative if it is. But if the profit is, if the profit is negative, in other words, you have loss, there's no point in taking all any of these ratios, right? So that brings us to, so in profitability category, we looked into 4 ratio variables, and in liquidity ratios, we, first of all, current ratio is time. Let's see if the slide is introducing the slide has probably in the slide, average collection period may be introduced as the asset management ratio. Is it? No. Oh, yeah, here, average collection period. Actually, it can be, it can be asset management ratio, or it can be considered, no, it is, asset management ratio, because, although average collect, the lower this number, the better it is. And if the average collection period is low, that means your cash flow your liquidity is good, right? So that's why you can also associate it with the liquidity ratios. And so in liquidity ratios, it's basically current ratio, and quick ratio. Current ratio is literally the ratio between current assets and current liabilities. Okay, and so obviously, because you have to meet the payment obligation in the current liabilities with current assets. So that means you must have, you must have more current assets than current liabilities. That goes without saying. But then by how much? I mean, that's why this ratio is a good measure. But maybe I forgot to mention before talking about the liquidity ratios. I forgot to. How do you know if it is good or bad? All these ratios are, I told you, they have to be positive numbers. But then whether it is good or bad depends on what is the industry average. Okay, so by your own number alone, it's hard to tell whether it's good or bad. I mean, as long as these numbers are positive, that's good. But then, what's happening? As long as these numbers are positive, that's already that's a good sign. But then, if you are below industry average, then that's not a good thing. You have to be at, you're doing, below, you're doing less than, you're doing much less than what the on average what the industry is doing, right? So always you have to compare it to the industry average. In all of these ratio categories, right? Ratios don't stand alone. They all have to be compared against the industry average. The only thing that stands alone is the liquidity category. In liquidity category, we have a clear benchmark, right? Clear criteria. First of all, for current ratios, we know current ratio is current assets assets over current liabilities. What is this? Current assets over current liabilities. And this ratio must be greater than 2, right? It must be at least greater than or equal to 2. And the quick ratio is basically current assets. I need more space. Current assets minus inventory, because you cannot rely on inventory, right? In other words, when you are in urgent cash flow shortage, right? When you are very tight with cash flow, you gotta sell all of the current assets. But inventory takes time. You cannot just liquidate inventory just overnight. Inventory takes more time, so you cannot really depend on the inventory, right? So you gotta subtract inventory, and you divide that by current liabilities. And this number must be greater than 1, okay? At least, equal to or greater than 1. So liquidity ratios can stand alone. I mean, because it's got a clear criteria, but still, you need to compare it with the industry average, because if the industry average for current assets is 6 and your current ratio is 3, you're still, below industry average. I mean, so it's, you're safe, you're okay for now, but you better bring up the current ratio to the industry average level, right? Because that's the benchmark, and if you're, if you're underperforming the average, then by any common sense, that's not good. You're not you're not really you're underperforming the average of the industry. So obviously that's not. Now, so current ratio and quick ratio, right? Those two are, a representative of the liquidity category, okay? And then the third category is asset management ratios, but I don't think we have time for that today. Let me just take a look. What time is it? Oh, 7:06. So we still have about 9 minutes. So yeah, let me go ahead. So in asset management ratios, right? First, I'm going to use this inventory turnover ratio and fixed assets turnover ratio. But I'm going to talk about average collection period, or days to, they call it days to, also average collection period, or days to collection, average days to collection, or something like that. It's about accounts receivable, right? Collecting accounts receivable. The inventory turnover ratio measures, it's, why is it like this? It doesn't show any formula. Okay, so I guess something is, when I convert it into PDF, sometimes some formatting is, oh, here, some formatting is gone. So it's here. There are two ways to so I need more space. So where do I put it? one inventory turnover ratio. And inventory turnover ratio breaks into breaks into two. One is for retail, the other one is for manufacturing, right? So here. First, I got it right. Inventory turnover ratio. One formula is revenue over average inventory, average, okay? Average inventory. The second formula is CGS over average inventory. Now you understand revenue and CGS are two sides of the same coin, right? Remember, revenue is the price side of the CGS. CGS is the cost side of the revenue. Hence, CGS is sometimes also called cost of revenue because it's the cost side of the revenue, right? And this is the inventory turnover ratio for retail. Retail business. And this is the formula for, I don't have to do. This is the formula for manufacturing. 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 Now, so what is the average inventory then, right? Since I cannot write here, it's the same thing, you know. Average inventory is basically a beginning inventory plus ending inventory divided by 2. Beginning inventory. So I'm not going to write that for retail method, but because it's the same. But the only thing is the same thing. But the only thing is in manufacturing, all the inventory are basically. I want to have different colors, but you know it doesn't allow me. Text? No, I don't need. No. So you know all the inventory, basically inventory is measured or valued in cost, right? In manufacturing, basically inventory is expressed in cost. Okay, so it's all in cost. In retail, inventory is expressed in what's going on? Expressed in selling price, in price, right? So that's how, then, revenue is, price side of, I've been telling you, price side of the cost. CGS is the cost side of the revenue. So for to take the inventory turnover ratio in retail, everything must be, all the data must be expressed in the selling price, right? Otherwise, this ratio would be overstated. Okay. We don't have, I guess, that's all the time we have for now. So we're going to talk more about this on Wednesday. Okay, on Wednesday. Any questions so far? So we'll have to call it a day or call it a night. Any questions so far? Any questions?
No, Professor. Have a good evening.
All righty. If you have no questions,
Professor, I have
a
a
great
question.
evening, everyone. Yeah. Who is this?
Yeah, but I'll stay after the class because it's like personal.
What's that?
The question is
Okay.
sort of
All righty. Yeah. Stay after. I'll first have to stop recording and dismiss the class for everyone. All righty. I'll see you guys on